So I want to talk about the economy and numbers, because if you watch this channel, you know anything about me. I've been teaching about abundance. I've been talking about the economy. I talk about leverage and investing and so many other things about monetary policy that I thought it was time to do another video about some misinformation that's out there. In order to be abundant, number one, it's about shifting everything that you believe about your own worthiness and your inner billionaire. That's number one. But number two, it's about understanding the world around you and how money works and how the relationship that you have with money. You know, we've got this thing called the stock market, which is like Vegas, that's sanctioned by everybody. And there's the bond market. And I've said this for a million years, that the bond market and the stock market are like teenage boys that make decisions like that their girlfriends just broke up with them. So I'm going to talk about this in just a second. We're going to get started right now because I want you to just know that we're going to talk about some money issues, and I want to break this down so that you can begin to be more empowered about how your money works and how it's coming and going from your life. Stay tuned. Here we go. I want to welcome to the channel. This is Debbie Dobbins, and I am the Queen of Magic, and also I just published my book called Your Inner Billionaire. And it's about shifting your relationship with money, but more importantly, one of the things that I share in that book is we can't walk around being afraid all the time. You're never going to have abundance in your life if you're just constantly in fear, right? So you have to trust, and you have to have faith, and a whole lot of other things. Get the book, it's fantastic. But I want to talk about the stock market and the bond market, which are like brothers and sisters to one another. And the stock market, to me, you got the NASDAQ, you got the Dow Jones. They trade with different companies, and it's very fascinating to watch people because, as I've said, they're like watching teenage boys. They're as erratic as a prepubescent child man that is like, oh my God, and they react. What happens is the press doesn't help the situation. Like when we had, now the Great Depression, the big depression, that lasted for a little while. And trust me, folks, we are not anywhere close to anything like that happening, nor will we probably ever be going forward. Even in 2008, when the government allowed deregulation or non-regulation of the mortgage industry, which was then tied to Wall Street. Hello, Wall Street again. And then we had to bail out the too big to fail. That crisis was directly created by the government, okay? And so there's plenty of movies on it, you can go watch it. But the fact is that even in that time, which was pretty devastating, their 401ks and their retirement accounts, right? Because the stock market drops. So this is the conversation that happens out there. This week, some numbers came out. So every time numbers come out, I guess like, this has been going on for so long that I just go, okay, the reports came out. So an inflation report came out for February. It was up 0.1% of what they thought it was going to be. Oh my God, inflation is on the rise. This is 1 month report. And Donald Trump is about to put tariffs on starting next week. So the stock market reacts like they always do. Like it's buying and trading. And a lot of times the reason the buying and the trading or the buying and the selling goes on is they're going into what's called the bond market. So it's a flight to safety. So let me explain something to you, that when the stock market goes up and down, the stock market, they're not pulling their money out and just letting it sit somewhere. They don't ever do that. They don't park it over here and do nothing with it, because people that invest in the stock market are very savvy, and they know that the money is going to go where it is going to earn more money. That's all that this is. It's Vegas. And so they're moving their chips around. The thing about it is let's say that you have a 401k and it's invested heavily, which should not happen, in the Dow Jones Industrial. Right? So when the Dow Jones goes down, because that's the only lead figure that you get, when it goes down, then your portfolio goes down, right? It's not like somebody comes in, it's your portfolio, it's a piece of paper, and it goes up and down and all around as long as you've had it. it's not as if someone's taking cash right out of your wallet. Now, here's the thing that I find fascinating is no one's putting anything in context. So the conversation I heard yesterday was, oh my God, the stock market is down. What about all these people that are getting ready to retire this week or this month? Like, oh God. Okay, first of all, you're talking about a retirement account. Just by the nature of the fact that you're talking about a retirement account. Like if you're a day trader, this might impact you quite a bit. But the fact is if this is a retirement account, generally speaking, now this isn't 100% true, but it's 95% true. You've been putting money into it over a period of time. Oh, I don't know. Let's just use 15 years because, you know, a lot of people don't start putting money into a retirement account till they're 40, 50, right? But if you've been doing it since you were 20, that would be a long time because you're not going to generally retire until you're about 65 or 70 even. Let's just say you're 65. Let's say you're retiring early because I'm almost 70. I don't know. I don't think I'm ever going to retire. But the fact is, let's say you're 65 and you've been putting in for the last, well, let's just say 20 years. You've been putting money in there since you were 45. Number one, you're putting it into a account, your 401k, your IRA, whatever, that has, you've been putting the money in. So any money that you put in from the beginning of that 20 years was already deflated by the time you get here, right? Inflation has killed you. That's not to say that your money's not growing, but the money that you've been putting in because our lovely government for multiple decades has not been taking care of you so that inflation has been out of control. But regardless, you've been putting money in there for 20 years and the money, if you have a good money manager, should have been growing at anywhere between 3 to 10, maybe 20% if you're in the riskier investments over that period of time. So here we are, over 20 years, the money's gone in, you put it in regularly, it's been growing, it's been growing, it's been growing, it's been growing, it's been growing. So you have this trajectory that's going up. And then all of a sudden the stock market goes, oh, I don't know, it goes down 1% or 5% or even 20%. Who gives a crap? It goes down whoop, right now, right? This little tiny bit over all this time, it goes eek, like that. And you're getting ready to retire. Trust me when I say, if somebody's blowing this so out of proportion that when the stock market goes up and down, which it does all the time, it's never gone completely up. I mean, that's an insane thought process. It goes up, it goes down, it goes up, up, and you can look over time. It's like a little, you know, a little heartbeat. So imagine somebody saying, oh my God, all of my 20 years of savings, I've just lost it because the stock market has reduced for 1% because of some news that they get volatile. It's going to come back. That's the nature of it. Unless we have some global crisis, which trust me when I say none of us are gonna know what that is. And they make them up because look at COVID. But the fact of the matter is, I would love for you to begin to look at this as this is normal operating procedure. The stock market is going to go up. The stock market is going to go up. It's going to go down. It's going to go up. It's going to go down. It's going to go up. It's going to go down. And overall, it's going to go up because that's how they've designed it. And then to have safety in your portfolio, right? So your 401k or your IRA should not be all in the Dow Jones. That's ludicrous in and of itself. You should have a balance of bonds and other types of investments, real estate investments, money market accounts, CDs, all the things, right? So the thing about it is when somebody scares you like this, that's because you're not taking responsibility for your own finances. So as I share these videos, I would love it for you to put comments about, wow, I didn't know any of that, or I don't understand this, or please help me understand this better. Because honest to goodness, most people don't understand money. They don't understand how it works. They don't know how it reproduces itself. They don't understand investment. They don't understand leverage. And when you begin to understand these things, you are empowered. And especially women. Women. You know, we've relegated for generations all of this responsibility to men. And honest to God, they don't know much more than we do. But the fact is that if you are not taking radical responsibility for yourself, for your own health and wealth, then you are letting somebody else take responsibility for it. And I can assure you, nobody has the best interest for you like you have for yourself. So this is just one of the episodes that I wanted to share with you. The stock market, it's such an interesting Russian roulette machine over there that people are gambling with. And then, you know, the stock market used to just be, here's a company, you can publicly trade, so people could invest in your company, buy shares of stock in it, and then if the company grows, your stock grows. But then we got puts and calls and shorts and all these other things that they use to manipulate the market. So when I say, until you understand that bit, and you're just giving an investor, you know, a Chase or whoever, an investment management company, the sole responsibility of your investments, that's probably not the best course of action without understanding what you're putting your money into. That's the key takeaway for today. But if you are doing that, do not get excited, whether you're retiring tomorrow or not, about the volatility of the stock market, because it's always been there and it will always be there. It's not something that you can control. And the fact is that your principal that you originally put in, do not pretend that you were at Vegas gambling and that all of this money, you were playing with the house's money at that point, right? You put in your $20 or your $120, your $120,000. That's your principal that you put in. The investment portion of it is how much it's increased. So if it's increased, let's say 100% over the past 20 years, and you lose a little, you're still playing with the house's money. It really isn't your money. I know you think it is, but the fact of the matter is when you go to gamble, this is your money. When you win and you play with it, it's the house's money. So this whole notion that we should be afraid kind of makes me laugh, because if you really understand money and how your money works for you and how you leverage it, all of this is out of your control, and I don't want to have someone be responsible for my money and how I invest it, because I know what's going to grow my money, and I hope that you will get a little takeaway here for yourself, that there's other ways, plus there's other ways to look at it. So I know that was a lot, but put your comments in the chat there, and if you want to have a Zoom call with me, check it out. There's a Zoom link in there. Schedule a call. Queen of Magic out.